Today on Real Estate Backstage, Donald Trump presses pause for 90 days on the tariffs for everyone except for China. We have encouraging data for both inflation and jobs in the month of March. Fannie Mae has fired over 100 employees over alleged fraud. And finally, Compass is pushing forward with its private listing network in direct defiance of MLS rules. Now, before we jump into today's conversation, if you're watching on YouTube or if you're listening on Apple Podcasts or Spotify, make sure to subscribe. That way you don't miss any future episodes of the show. And if you're looking for the show notes where you can find links to all the articles that we're going to cover today, you can find that at realestatebackstage.com/episode 24. Now, if this is your first time watching or listening, I'm your host. I'm Michael Smith. I'm the CEO and broker in charge here at Bluefield Realty Group. We're a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina. And we provide real estate brokerage, property management, and insurance services. So we're going to start with this tariff pause. This is according to Connect CRE. Quote, mere hours after imposing a range of tariffs on global trading partners, President Trump, via a Truth Social post, declared a 90-day pause on the reciprocal import duties, effective immediately, while raising tariffs on China to 125%. This followed his April 2nd Liberation Day tariff plan, which set a 10% baseline tariff on all imports and higher reciprocal tariffs on about 60 nations, including a 104% total on China, combining prior duties. The pause lowers the reciprocal rate to 10% for non-retaliating countries. China's tariff, however, jumped from 104% to 125% due to its 84% retaliation, which was up from 34% effective April 10th. U.S. equities surged after the announcement, with the major indices up between 7 and 10%. This reversed a $6 trillion loss in U.S. stocks since April 2nd. The rally reflected relief from a perceived de-escalation, though China's exclusion is likely to keep tensions high. Asian markets like Japan's Nikkei index, which was down 3.5%, and Hong Kong's Hang Seng, down 4%, had fallen sharply earlier, but U.S. optimism hints at a global rebound at their open. Government bond yields rose slightly, with the U.S. 10-year Treasury jumping to 4.4 from 4.27%, unquote. Now, here is Trump's post from Truth Social on Wednesday. Quote, based on the lack of respect that China has shown to the world's markets, I'm hereby raising the tariff charged to China by the United States of America to 125% effective immediately. At some point, hopefully in the near future, China will realize that the days of ripping off the USA and other countries is no longer sustainable or acceptable. Conversely, and based on the fact that more than 75 countries have called representatives of the United States, including the Departments of Commerce, Treasury, and the USTR, to negotiate a solution to the subjects being discussed relative to trade barriers, tariffs, currency manipulation, and non-monetary tariffs, and that these countries have not, at my strong suggestion, retaliated in any way, shape, or form against the United States, I have authorized a 90-day pause and a substantially lower reciprocal tariff during this period of 10%, also effective immediately. Now, this is according to the Wall Street Journal. Quote, it took a week for the plunge in the stock and bond markets, along with a sustained campaign by executives, lawmakers, lobbyists, and foreign leaders to prompt Trump to roll back for 90 days a major element of his sweeping tariff plan. He relied on his instincts to change course as he watched the bond market tank and listened to business leaders, including J.P. Morgan Chase CEO Jamie Dimon, express fears of a recession. The episode was classic Trump. He took a drastic action, closely tracked the reaction, kept advisors and allies guessing, and then changed course. In this case, the extraordinary reversal was announced via Trump's social media platform just hours after so-called reciprocal tariffs officially went into effect. He tapped out the post in the Oval Office as he sat with Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick. Shortly after Trump published his post, as markets rose, Bessent stood outside the entrance to the West Wing and explained that the move to pause some of the tariffs was discussed on Sunday when the two men met. He and I had a long talk, Bessent said before a crowd of reporters. This was his strategy all along. Bessent was flooded with worried calls from Wall Street over the weekend and felt strongly he had to persuade Trump that a pause was needed. It wouldn't be capitulation, he argued, because they were going to have so many deals. He revealed little publicly about why the president and his team waited until Wednesday afternoon to enact it, with Trump saying he had decided on the move Wednesday morning. Bessent said more than 75 countries had reached out seeking a deal to ease tariffs, with Japan at the front of the queue. One key to the change, Trump's decision to give Bessent more authority within his team of trade advisors, people close to the discussion said, along with the talks on Sunday. Bessent flew down Sunday to Florida and afterward was authorized to make comments publicly about deals. which heartened many people close to Trump who believed the Treasury Secretary could find an exit ramp. When the two men returned to Washington together Sunday on Air Force One, Bessent encouraged Trump to focus on negotiations, according to a person familiar with the conversation, unquote. All right, so just to recap, here is a quick summary of the timeline of events. So this all started last month during Trump's address to the joint session of Congress when he made public his plans to enact reciprocal tariffs. Now, the way Trump explained it, we would be charging tariffs on imports from other countries that were equivalent to the tariff rates they were charging on our exports. Now, there was a lot of speculation about exactly how these tariff rates were going to be calculated because it's a little bit more complex than it might seem at first glance. It's very rare that countries will just impose an across-the-board blanket tariff rate on all imports from a particular country. Normally, tariffs are more targeted at specific things like steel, aluminum, coffee, etc. So, for example, Canada charges relatively high tariff rates between 200 and 300% on things like dairy and poultry coming from the United States. But when you look at the trade-weighted average tariff rate that they charge on all U.S. goods, historically, it's been below 3%. So this is an example of how a country would use tariffs to subsidize and protect specific domestic industries. So the question was, if we're going to be putting reciprocal tariffs on other countries, how exactly are we going to do that? Are we going to match their weighted average across the board, or are we going to try to go industry to industry? So if you put a 20% tariff on steel from the U.S., are we matching that 20% steel that we import from you? Now, this, of course, wouldn't necessarily make sense because it's very uncommon that we are importing the same things from a country that we export to them. So trying to match industry to industry would be very challenging. Maybe you try to do a match based on dollar amount. So if they're tariffing 30% on something that they're importing, let's say $50 billion worth of that particular good, we find maybe an equivalent. Maybe it's something totally different. Maybe they're tariffing eggs and we're tariffing steel, but maybe the dollar amounts are the same and we try to justify it that way. So all this to say, it's a very complex calculation. So there's a lot of uncertainty about exactly how these reciprocal tariffs were going to be calculated and put into effect. So then we have Liberation Day on April 2nd. This is when Donald Trump came out to the Rose Garden with that big chart that showed the tariff rates that all these various countries were supposedly charging us. But it turned out that the data on that chart was just inaccurate. Donald Trump was quoting the trade deficit percentages. So the trade deficit that we have with that particular country as a percentage of our imports from that country, and he was calling those the tariff rates, and those are two very different things. Now, as a result of Trump's announcement, the markets reacted with trillions of dollars worth of movement. Investors dumped stocks and they piled into bonds as they were seeking safety on the expectation that the tariffs were going to dramatically slow our economy and push us into a recession. So for a couple days, we saw stock prices absolutely crater. Bond prices were soaring as investors moved money from stocks into bonds. And as a result, that pushed bond yields way down. So for a very short period of time, we had a reprieve in interest rates. The 10-year yield actually got below 4% in intraday trading, and we saw mortgage rates, 30-year fixed mortgage rates on average, fall below 6.5%. Now, during this period of time, during the first couple days of market chaos, Donald Trump was asked repeatedly if he would consider a pause on the tariffs. He said no. He said, is this people were asking him, is this something they're going to do to leverage to try and get people to the table to negotiate deals? And he was kind of sticking to his guns, saying that tariffs in and of themselves are good. This is going to be a great thing for our country. This is going to make us wealthy. We're going to reorient global trade. But he was also kind of sending some mixed signals, and we had people within his administration and within his orbit kind of retailing different theories as well. So, for example, we had people like Peter Navarro, Howard Lutnick, who's the Commerce Secretary, saying that these high tariffs were going to do wonderful things for America. They were going to make us rich. They're going to help us reshore all these manufacturing jobs. At the same time, we had people like Elon Musk, who's been very close to the president, Scott Bessent, the Treasury Secretary. They were both saying that the tariffs could be a tool that Trump uses as leverage to get people to the table, and that the ultimate goal would be to get other countries to lower their tariffs, and then we would lower ours. And the end result would be lower tariffs across the board and more free trade. We also saw a lot of outside pressure from people like Jamie Dimon, who, of course, is the CEO of JP Morgan Chase, people like Bill Ackman, billionaire hedge fund manager, publicly calling on Trump to reverse course or at least put a pause in place to give companies time to sort out their supply chains and figure out what they were going to do to try and maintain some semblance of profitability in the face of all these tariffs. Now, during all this market chaos, when interest rates were really low, we started seeing a lot of people on social media claiming that this was all some brilliant plan that Donald Trump had to intentionally crash the stock market and send bond yields down so that we could refinance large swaths of our debt at lower interest rates, which would ease some of the pressure on the federal budget, help us cut our deficit. In my opinion, that's just ridiculous. So next, we started to see a sell-off occur in the bond market. So again, originally for the first couple days, we were seeing the sell-off in the stock market, and we saw lots of people moving money from stocks and into bonds, which was sending yields down. But then investors started to realize, hey, as these tariffs actually start to work their way through the economy, we're going to see inflation, which means that bonds are no longer going to be the safe place that we think they are. So yields began to skyrocket, and I think that is a big part of what caused Donald Trump to actually change his mind and reverse course. So then on April 9th, Donald Trump announced that he was going to put this 90-day pause into effect, again, on everyone except for China. And that's allegedly because over 75 countries had reached out to the United States ready to come to the table and negotiate bilateral trade deals. Now, some of the same people that were claiming that Trump was intentionally crashing the market to drive rates down so that we can refinance our debt and save money in the budget, a lot of the same people who were saying that these tariffs were going to be a great thing for the country, tariffs are good, we need to reshore jobs. A lot of those same people are now celebrating the fact that Trump has paused the tariffs, saying that he's a brilliant negotiator. This was his plan all along. It's all about getting other people to lower their tariffs so that we can lower our tariffs and, get everyone to zero and increase free trade. People are saying this is some type of brilliant 4D chess strategy that Trump has been playing, but I just don't buy it. I genuinely believe that, Trump thought that this would be a good thing, but then he paid attention to the markets. He saw what was happening. He was listening to his advisors. And frankly, he probably saw that a lot of countries were willing to come to the table and start negotiating, and he saw an off-ramp and he took it. All right, so even though the tariffs are paused on most of the rest of the world, they have actually been increased even further on China. Now, a prolonged trade war with China would hurt the United States, but it would probably hurt China even more. You could make the case that it's worth the economic pain here at home in order to isolate China, to further decouple economically from China, because they are a geopolitical adversary, because they tend to be a bad actor on the world stage in terms of manipulating their currency, cheating on, like the World Trade Organization, not actually doing the things they're supposed to do since they've joined that many decades ago. Stealing IP, using slave labor for many of the products that we import here. I'm going to put a chart on the screen here just so you can kind of see the trade deficit that we have with China. Now, because we have such a big trade deficit with them, the tariffs actually will cause more harm to them than it will harm for us. So look at how much we export to China versus how much we import from China. So you can see that reciprocal tariffs, escalating tariffs, will have a much bigger impact on them than it would on us. All right, so shifting gears, let's talk about inflation. This is according to the Wall Street Journal. Quote, consumer prices declined month over month in March for the first time in nearly 5 years, a welcome development for inflation-weary families. The consumer price index fell a seasonally adjusted 0.1% in March. The Labor Department said Thursday, the first time it recorded a month-over-month decline since May of 2020. The drop was unexpected. Economists surveyed by the Wall Street Journal had forecast a 0.1% rise. Year-over-year inflation cooled sharply to a 2.4% increase in the CPI, which is below the 2.6% rise that economists had expected. A steep decline in gasoline prices last month helped pull that number lower. Normally, a slowdown in the year-over-year price increases would be welcome news for consumers who have faced years of high inflation and the Federal Reserve, which has been struggling to bring down price pressures. But this time, it will be hard for investors, policymakers, and businesses to read too much into the March data. President Trump's Liberation Day announcement of sweeping new tariffs didn't happen until April 2nd, which means their direct effects won't show up until the next consumer price report a month from now. It's good news for the Fed, but the data seems stale, said U.S. Bank Chief Economist Beth Ann Bovino. Hotel prices, airline fares, and gasoline prices all dropped sharply over the month, a sign that people are canceling their travel plans, one of the first things to go when consumers get nervous. In the meantime, consumers' grocery and restaurant bills continued to rise. Food prices increased 0.4% last month. Egg prices rose nearly 6% in March and are up 60% from a year earlier. Prices excluding food and energy categories, the so-called core measure that economists watch in an effort to better capture inflation's underlying trend, rose 2.8% on the year, below forecasts for a 3% increase. That was the smallest increase in the core measure since March of 2021, unquote. So, of course, that's great news. In March, we saw inflation decrease, come in below expectations. Very, very positive news. But again, there's still a lot of uncertainty around the tariff policy. And I think that's why the markets are still very volatile, still very jittery, even with the 90-day pause, because we don't know what type of negotiations we're able to have with this many countries in such a short period of time. Keep in mind, it typically takes years to negotiate trade deals with a country. For example, when Trump renegotiated NAFTA and put in the USMCA, I believe that took 13 or 14 months. It took several years to negotiate a trade deal with South Korea. So the fact that we're going to try and negotiate bilateral trade deals with 75 countries in just 90 days, there's a lot of uncertainty about how much can actually get accomplished, whether Trump is going to put these tariffs back into effect, what that's all going to look like. So we're not sure how inflation is going to be in the future, but the backward-looking data for the month of March was very positive. All right, so shifting gears over to jobs. Now, this is according to Connect CRE. Quote, non-farm payrolls for March beat estimates with 228,000 jobs added, according to data published by the Bureau of Labor Statistics, versus the estimate of 140,000. The unemployment rate ticked up to 4.2%, a three-year high, from 4.1%. Employers added 117,000 in February, which was revised from 151,000. Average hourly earnings increased by 0.3% in March, aligning with both the consensus estimate and the rise observed in February. However, on a year-over-year basis, wage growth decelerated to 3.8%, down from 4% in February and falling short of the expected 4%. Meanwhile, the labor force participation rate rose slightly to 62.5%, up 0.1 percentage points from February's 62.4%. Federal employment took another hit in March, shedding 4,000 workers. This decline comes on the heels of an even steeper drop in February when 11,000 positions vanished. However, these numbers might not reveal the full extent of the job cuts still rippling through the federal workforce. Economists predicted a decline of 10,000 to 15,000 federal jobs in March, yet the Bureau of Labor Statistics clarified on Friday that employees on paid leave or receiving ongoing severance pay are still counted as employed. The employment data collected before the Trump administration's latest tariff increases still reveal how employers reacted to earlier tariffs imposed on China, Canada, and Mexico, alongside federal layoffs and spending cuts. Considering the current labor market conditions and persistent inflation above 2%, the Federal Reserve is not expected to cut interest rates at their May meeting, unquote. So even though more new jobs were created in March than expected, we had a downward revision of the jobs created in February, and we had an uptick in the labor force participation rate, which means that there are more people who were previously out of work but not looking who are now looking for work. And this is why we saw the unemployment rate go up, even though we had a pretty solid increase in new jobs in the month of March. All right, so meanwhile, Fannie Mae has fired over 100 employees citing fraud. This is according to RIS Media. Quote, on Tuesday, April 8th, government-sponsored enterprise Fannie Mae announced that over the past few weeks, it had fired over 100 employees due to fraud, including mortgage fraud against the company. The announcement did not elaborate on the specifics of what the claimed fraud was. William J. Pulte, director of the Federal Housing Finance Agency, who was confirmed to the position on March 13th, issued a statement following the announcement. Pulte is also chairman of the board of directors for both Fannie Mae and Freddie Mac. He said, in President Trump's housing market, there is no room for fraud, mortgage fraud, or any other deceitful act that can jeopardize the safety and soundness of the housing industry. Since my swearing in, we fired over 100 employees from Fannie Mae who we caught engaging in unethical conduct, including facilitating fraud against our great company. Anyone who commits fraud against Fannie Mae does so against the American people, said Pulte. The fraud is described as a misuse of Fannie Mae's matching gifts programs, where the company will match employees' eligible donations to causes and organizations up to $5,000. The fired employees allegedly colluded with organizations to misuse Fannie Mae funds for personal gain, unquote. All right, so we're going to wrap up with a story about Compass's continued push for their private listing network in direct defiance of the Northwestern MLS. Now, this is according to Real Estate News. Quote, the war over private listings in Washington state is quickly escalating as Compass appears to have instructed its agents to disobey local MLS rules prohibiting pre-marketing of homes, while also seeking to build a database of seller clients who could potentially take legal action against the Northwestern multiple listing service. But the campaign started with a blitz of private exclusives. Since March 20th, Compass CEO Robert Refkin has publicly highlighted a number of agents in the Seattle area who were the first to participate in the brokerage's three-phase marketing strategy and list their sellers' homes as a Compass private exclusive. The first was Sam Cunningham, who Refkin applauded via Instagram and LinkedIn. Speaking to Real Estate News about Compass's private listings push in the Seattle area, Cunningham said it was an effort that had come from the top down and was strategically coordinated as a test pilot. Cunningham, who launched the first Compass private exclusive in Washington state, said the reality is that pre-marketing is going to happen anyway. In fact, he noted it's already happening, with 20% of our sales in Washington state happening off-market. So those sales are happening between realtors who are already doing this. What I'm talking about is like prohibition. Everyone's already drinking, so why don't we make it legal? Compass's pre-marketing blitz in the Seattle area was likely intended to force NWMLS to take action, either by penalizing Compass agents en masse for breaking its rules or by making an exception to those rules. Compass leadership told local agents participating in the effort that the brokerage would remain committed indefinitely to covering any fines from NWMLS resulting from the private listings push. Real Estate News learned and Cunningham confirmed. Cunningham said that the fine for pre-marketing a listing could be as steep as $5,000, but he wasn't contacted or penalized by NWMLS for pre-marketing a home. After listing his seller's property for 5 days as a private exclusive, he ended up putting it on the open market, and the home went under contract shortly after going on the MLS. NWMLS declined to comment on the story, but previously published an open letter on March 28th, reiterating its position on pre-marketing, arguing that such strategies are misguided and exclusionary. NWMLS reportedly warned Compass agents not to post private listings after March 28th, but it's unclear if the organization will ultimately decide to issue fines. Either way, Compass is likely to continue its pre-marketing strategy, unquote. So this, of course, comes on the heels of our news from last episode about NAR making an exemption to the Clear Cooperation Policy. Of course, they've decided to keep the Clear Cooperation Policy in effect, which says that if you do any type of public marketing of a listing, you have to submit it to a NAR-affiliated MLS within 1 business day. However, they are going to allow each MLS at the local level to decide on a certain period of time where that listing can be active in the MLS but not be syndicated out via IDX to third-party websites like Zillow, Realtor.com, etc. So Compass is pretty brazen here. They're offering to pay all the fines for their agents if they're fined by this particular local MLS here in Seattle. So we're going to keep an eye on this and see what happens. It would be interesting to see who caves, either the Northwestern MLS or Compass. All right, y'all, that's a wrap for the show today. Just a reminder, you can find the show notes with all the articles that we reference at realestatebackstage.com/episode 24. And I'll see you back here next week with another behind-the-scenes look at the real estate industry here on Real Estate Backstage.